10 retailers collapsing right in front of our eyes. Retailers are on the verge of a huge collapse due to the ongoing retail apocalypse that has seen numerous stores shut down. Even the most successful retailers are feeling the pinch as their companies are falling apart. The situation has made some go bankrupt, while others have resorted to selling their companies to reduce the burden. The bigger question is, when will this nightmare end? As the economic stress shifts from bad to worse, we're going to share with you the affected retail companies and how this economic storm is eating these firms alive. Let's start with Bed Bath & Beyond. They specialize in selling household items and have been around for 5 decades with billions of revenue recorded each year. However, this successful fairy tale is to be cut short with the recent retail apocalypse, which is crippling its operations. The core cause of the problem is the erosion of sales, as indicated by a 33% drop from the previous year. Similarly, their market shares degraded further because most investors were afraid to put money into a business that is struggling to make ends meet. The decline in revenue has dragged the company into the bigger hole of bankruptcy. They have failed to raise funds from investors to facilitate numerous store closures in order to cut costs. As a result, its operations in Canada were halted completely after it closed the remaining 54 stores in April. To add salt to the wound, 580 stores are facing closure in the U.S., a few moments after the company filed for bankruptcy. Second on the list is Boxed Company. The Boxed Company specializes in selling health supplies, household products, and groceries through its e-commerce platforms. Their sales went down because they sell products from private labels, unlike most stores that sell products from global brands. This marketing approach caused them to record a series of losses from the previous 4 quarters. Similarly, the loss gap was even larger, as seen from the transition of the previous $5.9 million to the current $26.3 million. This has proven to be a hard situation for the current CEO, Huang Che, who is considering selling the company to new owners. The CEO confirmed that they are in the process of closing stores in an attempt to reduce operating costs. More fuel was added to the fire as their stock price shrank, and they were removed from the New York Stock Exchange, which limited their ability to attract shareholders. As of April, the company was registered to be bankrupt, as the final turmoil is yet to end. Independent Pet Partners is the third company on our list. The company specializes in selling pet food and other pet commodities. This company was deeply affected by a change in consumers' behavior towards certain pet foods. For example, people stopped buying high-protein, grain-free dog food, and this played a part in their losses. As a consequence, 60 stores have been shut down as the company is battling with insolvency. As part of fighting the battle, the company is inviting new buyers who can save the company before the potential worst can happen. In fourth place is Starbucks Company, which is known for its production and retail of coffee worldwide. So, what's happening to Starbucks? Well, a lot of factors have pushed Starbucks to halt operations in some areas. To start, inventory shrinkage has been a major concern for their stores on the West Coast. Specifically, Seattle and Los Angeles have proven to make running a business almost impossible due to the alarming cases of burglary and armed robbery. There were also concerns about the safety of their employees, and this caused the closure of 16 stores in the area. Secondly, the change in consumer behavior has caused numerous stores to shut down. The shift from brick-and-mortar stores to e-commerce has led to the termination of 200 stores in the U.S. Third, the company's sustainability has become such a problem that management is targeting to remain with roughly 600 stores. They expressed that they will close 400 more stores in the U.S. and 100 stores in Canada to save money. Their sales in China dropped by 26%, and this has been linked to the zero-COVID policy introduced by the Chinese government. The policy has ignited a lot of restrictions that have caused supply chain issues, which have made some stores in China have to close. Hundreds of stores have been closed as Starbucks is finding a solution to that problem. Tuesday Morning is the fifth retailing firm on our bucket list. This company specializes in selling lifestyle and home goods and has been around since 1973. The longevity of the company is now edging towards its complete halting of operations. As per Tuesday Morning data, it has experienced a 10.4% decline in sales in the first quarter of 2023. The frustration this company has been facing is endless, and the management's not making it any better. As a matter of fact, the company filed for bankruptcy not once, but twice, and this sums up why its problems are compelling. Management has resorted to liquidating the company, 30% discounts to dispose of its inventory. In addition, the goods being sold at throwaway prices is also an indication that the company is looking forward to a quick and efficient wind-down process. So far, 222 stores have been closed, and this has affected 25 states in the U.S. where their branches were. The sixth retailing company to be affected is the world's leading mattress producer, Serta Simmons Bedding. Despite its legendary status after nearly 15 decades of operation, the company is finding itself in big trouble. Why? Well, uniquely, Serta does not seem to have sales problems like other retail companies, but the main point of concern is how they deal with debt. Equity ownership is putting the company under intense pressure, as the company is exploring alternatives for reducing the debt from $1.9 billion to $300 million. The debt trap robbed the company of not enjoying the fruits of their sales. The situation has shifted from bad to worse since it filed for bankruptcy because they've failed to obtain a permanent solution for paying its creditors. This has destabilized the operation of the company following a closure of factories and stores in Kansas and Iowa and Virginia, which have seen hundreds of workers being laid off. Now here's an interesting twist. Did you know that Olympic sports made $320 million in 2022? The company that was once lying in a bed of roses is now sleeping in a bed of thorns. Imagine going from $320 million to zero net worth. Quite a massive financial massacre, right? And that takes us to the seventh retail store to be hit hard, Olympia Sports. The company has officially departed for good after 38 years of operation in what appears to be a painful farewell. This has been due to stiff competition from companies like Amazon, which have robbed the company's ability to maximize sales. The shift in consumer behavior from a brick-and-mortar store pushed the company to the wall. This was followed by a series of shutdowns from 2019 to 2021, where 150 unprofitable outlets were not spared. During the closure, liquidation was also taking place to reduce the inventory owned. Things took a bigger turn in September of last year when the company filed for bankruptcy, which saw the remaining 75 stores being sold to a private equity firm, hence bringing its demise to the business world. Joules Clothing Company is the eighth retail company to face the wrath of the economic storm. The UK-based company affirmed that sales have decreased substantially since October of last year, bearing in mind they faced an 8% drop in August. Ever since, life has not been the same for the company because revenue projections recorded are low, and this poses a lot of questions about the company's stability. Furthermore, wary consumers are not willing to spend more on clothing since foodstuffs remain a top priority. With the company struggling to finance the payroll and millions of debt, harsh measures are expected to be implemented. As a consequence, 133 employees will be fired and 10 stores will be closed. Areas such as Watford, Waterloo, Oxford, Exeter, Edinburgh, Cheltenham, Gateshead, Peterborough, and Newbury are a few of many areas to be affected by the closures. This is not the end, as management is narrowing down to 80% of shutdowns for their administration to be smooth. Conversely, the financial woes are biting so hard that they are inviting new investors to take 74% of the share while they remain with 26% of the ownership. Next is Party City, which sells party supplies, decorations, costumes, and balloons. Party City has enabled party lovers to enjoy life to the fullest. However, it appears that the party is over, as the company is smelling a potential closure. Sales have been hampered by supply chain issues, which have depleted the bigger part of its earnings. 2. The company is struggling to fund a huge debt of $1.7 billion. This has proven to be quite intimidating since their assets are only worth $122 million. Mathematically, the debt is 14 times their liquid assets. Quite shocking, right? With the overwhelming financial obligation, the company was declared bankrupt as of mid-January. Moreover, this has led to 22 store closures, which will affect their outlets in West Virginia, Texas, Oregon, Oklahoma, New York, New Jersey, Missouri, Michigan, Louisiana, Illinois, Iowa, and Georgia. Lastly, M&C is closing its doors due to a switch in user habits. The UK-based fashion powerhouse is facing a menacing problem with low revenue in the first quarter of 2023. The company has noted a considerable decrease in consumer appetite for its products, which has made sales seem malnourished. Equivalently, the company is set to close 170 stores, and 1,900 jobs will be affected. Seeing retail companies fall at such a frightening pace, where's the business environment heading? This is the question numerous owners seek to find an answer to, as the potential worst is yet to happen.